Welcome to our conversation on understanding the impact of the stock repurchase on the financial statements. In the previous presentation, we saw when the shares are repurchased, the treasury stock is shown in most of the countries as negative equity, and cash is reduced to the extent of the purchase of the treasury stock. And if this treasury stock are cancelled, then capital will be reduced to the extent of the face value of the shares. And since there is no share premium at the time of the issue, the excess money paid to the shareholders will be reduced from the retained profit. No effect on the income statement. And now let us see, if the shares are not cancelled, but the company reissues these 8,000 shares, then what will happen? Let us assume that the company reissues the shares at 30. Once again, this can be at any price. Depends on the markets. So if it is reissued, so assuming that all 8,000 shares are sold at 30, so then the company is getting back the receiving cash. Company is receiving cash of 240,000. Company is getting cash of 240,000. How did we get this 240? That is 8,000 shares into 30 is this cash 240. That means the shares which they purchased at 25, the company purchased at 25, holding on to that as quasi investment, they're now selling it at 30. As a result, the treasury stock will no more be there on the balance sheet because the treasury stock is been reissued to the public at large. But the cash you have received 240. So cash available in the books is 740. There is no other payment. So therefore cash in hand is 740. So to the extent of the reissue of the bought back shares, cash goes up. What happens? But the treasury stock is reduced by 200,000 only. So the difference between the sale price of the reissued shares and the purchase price of the treasury stock is considered as a profit or a premium on reissue of the treasury stock, which is share premium. Observe, this will not be shown in the income statement. Those are the generic principles. And that will be shown on the balance sheet as a premium on reissue of the treasury stock. And that will be part of the equity of the company. So when the equity is calculated, the equity will include the premium on the reissue of shares too. So the total of the sources side should be equal to the total of the asset side. So if the shares are reissued, therefore, the profit on the sale of shares is on the reissued shares will not be shown on the income statement, will be shown in the balance sheet as the premium on reissue of treasuries, reissue of the shares. Suppose if the shares would have been sold at 25, observe they were purchased at 25 and sold at 25, so there is no profit, so no premium, still the balance sheet tallies. Suppose they purchased at 25 but they sold at 15. If they sold at 15, so there is a loss. So this loss should be adjusted against the retained profit instead of showing it as a premium on negative premium. Okay, so let us go back to the original number, so 30. So the profit on the sale of shares will be shown as a premium, or it sometimes, because it can be also shown included in the retained profit. So therefore, to summarize, if the company makes a purchase of its own shares, they're normally shown as the treasury stock. And if they are cancelled, the treasury stock is reduced, then capital is reduced, any excess money paid is adjusted against the retained profit if there is no share premium. But instead of cancelling the shares, if the shares are reissued once again, they are not cancelled, but they are sold once again, in that case the profit will be adjusted as in the balance sheet as a premium. So therefore, the generic principle of the buyback of share, that whenever there is a buyback, show that as a treasury stock on the date of the purchase. But as mentioned, in some specific countries like India, they are always cancelled. The shares have to be cancelled. If that happens, the concept of treasury stock will not be there. We reduce the capital and reduce the profit. And if the company holds that, then the treasury stock will continue to appear on the balance sheet as negative equity. And if they are sold, whenever they are sold, the profit or loss on the reissue of the treasury stock will not be shown in the income statement, but will come to the balance sheet. So buyback of share is therefore as an interesting and important business decision the companies take in order to manage the share price, because we expect the book value per share to change, and we expect the price of the share is a function of the book value and a function of the earning per share. In this case, we have assumed there is no income given, so we could not examine the earning per share in this case. So therefore, buyback of share is a mechanism of managing the idle cash or using the idle cash to increase or manage the shareholders' return. And a balance sheet will have an effect in the form of, at the time of the purchase, there will be treasury stock as a negative equity. If it is cancelled, the treasury stock becomes zero and the capital is reduced and premium or the retained profit is reduced. But instead of cancelling the shares, if those shares are once again issued by the company back to the market, then cash will increase once again. The treasury stock is cancelled because there are no more negative equity. Any profit or loss made on that will not be taken to the income statement, will be adjusted in the balance sheet. Thank you very much.